I had him on mine, and he's an amazing, amazing mind, and no one knows the LBMA better than him. But I would argue, after talking with him a few times and reading his stuff and digging as deep as I can, that the London Metals Exchange holds virtually no physical silver, at least relative to, according to David, the 2 billion ounces of cash spot market contracts that could stand for delivery for immediate silver bar ownership. And I mean, as far as I'm concerned, the stress in the LBMA, and, you know, when you have either the stupidity or the courage to say what you believe, it's also good to have been proven right. You know, I don't have a crystal ball. When I said buckle up in November, it wasn't because of a chart pattern. It was because you could see, if you look closely, if you open your mind to looking and seeing outside the box, right? Which is something I've always really found easy, to look outside the box. And, you know, growing up in high school and college, it maybe didn't always serve me so well, but in the big picture, I think it does. And I think you have to look outside the box. Conventional wisdom in unconventional times serves you wrong, in my opinion. Anyways, you could see that the paper price and the physical reality were on a collision course. I mean, look, let's just first zoom out for a minute, okay? So silver didn't just drift higher. In my mind, it's repriced. It went from the 20s and 30s early in the year to, you know, now into the 70s and now into the 80s. That's really not normal for a market that is this critical. But what I would argue, Jesse, is that price suppression always ends badly, period. You can only manipulate a market or push it in the direct, over a long period of time, push it in the direction that it is going. And you have some very strong forces pushing against the price suppression. Let's talk about policy shift for one moment. You now have the U.S. moving silver into the critical mineral category. And this frames silver for national security, not just as a collectible metal or a monetary metal. Response to that, the massive choke point. China tightens the gate on refined exports. And this matters because they are responsible for 70% by most sources of refining the doré bars that come into the market, come into the West. In my mind, this is about ownership more than anything else. It's about physical ownership. Now, when I look back, I would have said that the central bank's buying and the fact that there's no counterparty risk, all of this stuff was big, right? But COMEX is telling you the truth right now. And if you want the real story of what's going on, and it's very easy to see this, is in fact, it's really the only thing that I focused on, truthfully. A standard COMEX contract is 5,000 ounces silver. Gold is 100 ounces. But when you see sustained, now this is going on 15 months now, 16 months, outsized delivery demand on COMEX, what you're really watching is a fight over the real inventory, not just speculative paper positioning. And let me just try and explain what I mean. In December, there was 3,706,000 ounces of gold delivered. I mean, as big as it gets, but 64,730,000 troy ounces of silver issued and stopped. Issued and stopped is a fancy word of saying delivered. Now, not all of it leaves COMEX, but a lot does. So let me ask you a question. Who the hell's got, and that's an all-time record for the month of December, who's got money to buy 65 million ounces of silver? Let's let that sink in for a second. But this is every single damn month since November. And what really pisses me off about all of this is there is no mainstream acknowledgement of any of this. Go turn on the news tonight, watch silver ripping to all-time highs, and you won't see a word about it. And where is the journalistic integrity in the idiot Jim Cramers of the world who would say, you know, Who's buying 65 million ounces of silver in the month of December? And I'm sure he didn't talk to us about the critical mineral designation or the fact that China, the massive refiner, said we're going to limit exports. But if a mint box of Silver Eagles, which is 500 ounces, weighs 42 pounds, who just took possession of 65 million ounces? Let that sink in for a minute. Now, January, Jesse, is not a scheduled delivery month, but you can still take delivery. But here's where it gets crazy again. Supporting the only thing that matters, right? The most well-funded, well-informed traders, the most well-informed traders in the world are doing this, right? They don't do this, pardon my French, for shits and giggles. I don't mean to be profane, but I want to be profane so that it sinks in. This is all you need to see, right? Forget about the noise. Forget about the rhetoric. Forget about anything. When the most well-informed traders on the planet, now I've been talking about the central banks forever, but who's doing it here on COMEX? Stand for delivery every single month since he was elected last November. This is 4 feet of snow in Death Valley in July, how unusual it is. So, at this level, Jesse, delivery is the only message. And so for 2026, I expect higher volatility. I expect Oh, by the way, did I mention? Yes, I did. I did mention how much that was. Maybe I didn't. So for January, for the first 3 days, we've seen already, just in the first few days of the January delivery, 6 days, 7 days. Last I looked, last week, Friday, we saw 33.45 million ounces of silver delivered just in the first few days of January. So that's almost 7,000 contracts delivered just in the first few days of a non-scheduled delivery month. Who's doing this? That's all that matters. I do expect higher volatility. I think a market that increasingly trades on availability, not just price. We've seen a backwardation, constant backwardation, which means that there's more demand for it right now than I'm not going to trust you into the future, which is supposed to be the opposite. You're supposed to see a higher price into the future because it takes into account interest, cost of money, storage, all that stuff. No, I want it right now and I'll pay you more for it because I don't trust you that I'm going to get it. And I want people to remember one thing. I don't sell gold and silver to become wealthy. I sell it because it is wealth. I've said this a million times. The wealthiest people in the world own lots of it. So sure, you own enough of it, you'll be wealthy. You do not buy it to become wealthy. However, when you think of where this can go, silver is just a tiny little market relative to the capital that can and is flooding into it. When that happens, Jesse, the move can be fast and quite disorderly. So in short, I would say the buckle up still applies, brother.
Silver's transformation accelerated when governments quietly changed how they define it. Once viewed as both a monetary and industrial metal, silver is now being classified as a critical mineral, placing it squarely inside national security frameworks. At the same time, China, responsible for refining the majority of the world's silver, has tightened export controls and prioritized domestic supply. These are not routine policy tweaks. They signal a shift toward resource protection and supply weaponization. When a metal becomes strategic, availability matters more than price. Markets no longer function on abundance, but on access, and access is increasingly political.
Well, first of all, I'll say technical analysis is good, but in a rigged market, one that has never been allowed to find real price discovery, I would say it will do nothing but mislead you. No disrespect to the technical analysts, because it's a very valuable tool. But technical analysis, I think, also assumes a fair and orderly, free market. And when you have a market that's been suppressed for as long as this one has, I would caution people to rely too heavily on technical analysis. However, you're right, absolutely. Some caution is always warranted, especially after a move like we've seen. And when everyone starts talking about something as a certainty, that's typically when the market reminds you that it doesn't care about your conviction or what you believe to be true. But that said, I would separate price risk from thesis risk. I mean, in the short term, yes, silver can absolutely pull back. It's a thin market. And after any vertical move, you can see what they would call a sharp air pocket, where profit taking comes in. As Johnny said, margin pressure that we've seen recently, headline risk, yeah, it's a top, it's overbought, all of that stuff, you name it. But a $10 and $20 correction in silver is not only possible, it's normal in a bull market. You know, people are thrilled when it goes up $8-10. Well, we haven't really seen an $8-10 move, but we might today. It's up $6 already. But these types of corrections is normal. But it's the underlying conditions that I want to remind people that got us here. Tight physical availability, massive delivery demand by the most well-informed and well-funded traders in the world, critical mineral designation, mineral wars between nations. It's not two brothers trying to corner the market like it was in 1980. And what you see is massive delivery demand in a paper market that's been asked to settle real world demand in real metal that it probably doesn't have. That's a problem. And so, yes, if you're asking, could silver drop next week? Of course. I'd actually be surprised if we didn't get a violent pullback along the way. The bull wants to take as few of us along as possible. That's why no one really ever succeeds in investing. Most don't. This is why they have wave theory. Elliott wave, Kondratiev wave, which speaks to human emotions driving the market, fear, exuberance, panic, all of these things. But this is why if you separate yourself from the herd and see the reality, where a pullback doesn't change the bigger picture. And in fact, I would argue in a market like this, a dip is a gift, because this dip would be driven by positioning and leverage and not by sudden surplus of silver, right? So my advice is simple. Don't get cute with timing. If you're a trader, trade it. And that's what the technical analysts are. They trade, right? But if you were trying to protect your purchasing power, to me, the risk isn't that silver goes from 80 to 70 for a minute. The risk is waking up in a market where you can't get what you want at any reasonable premium, and the price you thought you'd be able to buy it at is gone. So yeah, short-term caution, sure, yes. Long-term conviction, also yes. And in my opinion, both can be true at the same time, and in this case, I think they are.
The clearest warning isn't found in headlines. It's buried in delivery data. On the COMEX, demand for physical silver has surged month after month, far beyond historical norms. Record volumes of metal are being demanded for delivery, not traded as paper claims. This isn't speculative positioning. It's a direct contest over real inventory. December alone saw unprecedented silver deliveries, followed by massive withdrawals in a month that typically sees little activity. Only the most capitalized and informed players can execute moves like this. When they demand metal consistently, they're not guessing. They're preparing.
Super good question, Jess. I mean, because to me, that's one of the most important tells, if you will, for poker parlance in the whole market right now. When you see the Shanghai Metals Exchange consistently pricing silver above Western spot and futures, it's basically the market screaming that the metal is worth a whole hell of a lot more, not only where it's needed, but from where it is being financially priced. And it's the market's way of saying you're full of crap, COMEX and LBMA. And the Shanghai ecosystem is far more tied to real metal moving to real end users, industrial fabrications, wholesalers, etc., where the West sets the paper price largely through leverage paper futures that is now beginning to be viewed as fugazi. The widening spread that we see is a signal of tightness. And it's not a rounding error, man. And it's perhaps the beginning of real price discovery for the first time ever, right? Because silver has never been allowed to find its real price discovery, because I don't care what anyone argues with me on. It is my belief 1,000% that it is the military industrial complex of the West that needs silver for high-tech weaponry, period, that has suppressed the price. And it's not just the United States, it's all of the Western military, France and the United Kingdom and all of the strong militaries across the Western world that have used military to in essence, rule the world for a very, very, very long time. And it's not even about the price of it going too high because it's inelastic. You need just a little bit for a very high priced piece of military equipment, but you need it. And if the world figured out just how valuable it was, well, that would be a problem. So if the West and the military industrial complex wants to rule the world, sell all their weapons, not just to the West, but through the NATO allies, and then continue this. And then, of course, when you see countries getting blown up with said missiles, who gets the reconstruction contracts very often? Well, it's BlackRock, which is a military industrial complex. And it's just, you have to take a step back from conventional thought and wisdom and the people giving you advice. Maybe don't see the world quite the way that you do. And I'm speaking to all of you out there. And if all these, your financial advisors say you're crazy and why would this be true? Because the people that are doing this don't see the world the way that you do. And we've been right, us watching this show, we've been right. And it's about time that we get some acknowledgement of it from the financial media, saying, geez, we were wrong. Well, that isn't going to happen. Anyways, I would say it like this, man. The East is doing price discovery in the physical, and the West is still doing price discovery in the paper. And the spread is what happens when those two worlds stop agreeing. And if this continues, especially if it widens, and the early stage evidence is that it is widening, the physical market is starting to overrule or override the paper market, period. And when that dam breaks, the move often, I would think, isn't polite. It'll be chaotic and maybe even disorderly.
A growing divide has emerged between physical markets in the East and paper markets in the West. In Shanghai, silver regularly trades at a premium to prices set in New York and London. This isn't a minor discrepancy. It's a structural warning. Eastern exchanges are grounded in physical settlement, supplying manufacturers and end users. Western pricing, by contrast, is driven by leverage-heavy futures markets. When these systems stop agreeing, spreads widen. That gap represents mistrust. It says buyers want metal now, not promises later. Historically, when physical markets overrule paper ones, price discovery becomes chaotic.
I had him on mine, and he's an amazing, amazing mind, and no one knows the LBMA better than him. But I would argue, after talking with him a few times and reading his stuff and digging as deep as I can, that the London Metals Exchange holds virtually no physical silver. At least relative to, according to David, the 2 billion ounces of cash spot market contracts that could stand for delivery for immediate silver bar ownership. And I mean, as far as I'm concerned, the stress in the LBMA, it shows up not in the cost of the metal, but it shows up in the borrowing costs like we're seeing, or the leasing rates. A lot of people don't know, but you can lease silver for whatever reason, to cover contracts or to fulfill obligations or whatever you need. You can lease silver, and normally the lease rates are sub 1%, right? Less than 1%. But what we're seeing now is 7, 8, 9%, and it was as high as 30% a few weeks ago. But that's exponentially higher than it normally is. And if you're a real buyer trying to source size in London, what we've been told all year is it's 8 weeks delayed. Sorry, there's a shortage of manpower and trucks in London, which is just the biggest bunch of crap I've ever heard in my life, because they're a T+1 settlement market, where T is trade plus 1 is settlement, and the next day those bars should be moving. But listen, Bank of England has a little bit of shortage of trucks right now and manpower. So, Jesse, I know you need your bars, but 8 weeks, bro. Sorry. And I think it seems like because of this stuff, we're getting closer to that moment where the metal left inside the vault is not the metal that's actually for sale. And David would tell you that they have like about 800 million ounces of silver there, of which almost all of it belongs to the ETFs and supposedly and other holders, that it's not for sale. And he would say there's about 140 million ounce free float, but he will question that too. He'll question that, is that free float really a free float? He thinks most of it is encumbered. But once this becomes obvious enough to players not just guys like you and I asking these questions, or David Jensen, or the pimple on the elephant's ass that is reading all and listening to us. And I mean no disrespect, because it's a growing crowd, but the mainstream has zero idea because of the lack of any measure of journalistic integrity across the mainstream. But once people start to understand this, and I don't know, to me, price discovery doesn't happen on a screen. It'll happen in the real world. And again, talk about this disorderly. It will get disorderly fast once the mainstream understands that this game of metal suppression is ending, and ending badly.
Strain is also visible in places few retail investors ever look: leasing and borrowing markets. Silver lease rates, once near zero, have surged to levels that signal scarcity, not abundance. Delivery delays, rising borrowing costs, and shrinking free float inventories point to a simple truth: much of the metal in vaults is not actually available. It's already spoken for. When vault inventory exists mostly on paper, confidence erodes quickly. Price discovery doesn't fail on screens. It fails when buyers are told to wait weeks for metal that was supposedly settled tomorrow.
Yeah, you're right. It is a tight supply chain, and this is a tightening of the valve. And especially for a market that runs at just-in-time inventory, it can get potentially very interesting. It can get very interesting. So the Chinese, what's it called? Chinese Ministry of Commerce publish a white list of 44 companies allowed to export silver, and anything outside that lane is effectively shut out. There were many small and mid-sized refiners that would send metal out into the West, and those are done. And even those approved evidently face like a big additional licensing step, which means more time and cost and paperwork, and Beijing can slow things down whenever they really want. One of the things that people missed about this, to me, first of all, China refines 70% of the doré, right? And so those that were approved are state-run, and the state did something in November that not a lot of people talked about, and that was that they came out with something saying, we are going to prioritize exports for domestic necessity, for domestic demand. And that was quiet. But in essence, what they are doing is basically, in my mind, they're prioritizing domestic supply. And this is going to raise the risk premium, which basically means, am I going to get it, right? And the uncertainty widens spreads, right? And so this is why you see lease rates going higher, and rates and borrowing costs, as we are seeing, are indeed accelerating. And I think it will also accelerate industrial stockpiling by locking in supply, which will tighten the market further. In other words, who the hell is standing for possession of all of this metal? 38 million ounces just in the first 6 days of the January non-delivery contract month, right? And the 68 million or whatever in December, all-time record. I wonder, could it be someone like the U.S. government, now that it is a critical mineral, stockpiling? Could it be Tesla, Samsung? We were already told Samsung went to Mexico. As I've been saying on your show before, China's been doing that for 2 years, going right to Mexico, the number one producer, China's two, and to Peru, the number 3 producer, and buying up all their doré and concentrate, paying double what the West will, shipping it home and refining it. Well, Samsung just did that themselves. You are seeing a disintermediation of the market. They're going right to the source, buying doré and concentrate, which isn't reportable, which isn't verifiable in terms of purity, and in terms more so of how much. I think the takeaway for investors is the same. When a government turns a commodity into something strategic, and another government adds licensing friction, supply becomes more political, maybe much less available. They call that elastic. And in a small market like silver, it doesn't take much to create a big price response. So you do not buy it to get wealthy. However, you're looking at a once-in-a-generation type of thing.
Short-term pullbacks are inevitable in a market like this. Silver is thin, emotional, and volatile by nature. But volatility doesn't negate the thesis. It confirms it. Corrections driven by leverage and positioning are not the same as reversals caused by surplus supply. The real risk isn't a temporary price dip. It's waking up to a market where physical silver is unobtainable at any reasonable premium. Silver is a small market facing strategic demand, geopolitical friction, and shrinking supply. When availability replaces price as the deciding factor, moves are rarely orderly. This is not a trade, it's a structural shift.